Hi everyone, and welcome to the WireX Crypto Podcast. I'm your host Lianna, and I'm very happy to introduce our guest for today, Malak Albaw, COO and co-founder at AB Launch. Welcome, Malak.
Hi Lianna, thank you for this introduction. My name is Malak Albaw. I have experience in startups for over 4 years. I've been working in the crowdfunding industry where I help startups and creators around the world raise funds through Kickstarter, Indiegogo, and Seeders. We help creators worldwide bring their ideas to life through crowdfunding platforms. I've done a 16-month exit with a sustainable e-commerce brand, and I have a show called Web3 Vibes that talks about the impact that founders bring to the table with their blockchain solutions. So I'm quite excited to delve deeper into everything related to Web2 and Web3 startups, talk a little bit about the death of Bali and whatnot.
Amazing. Can you tell us about, the common pitfalls startups face in their early stages?
Of course. So most startups, if not 95% of startups, they fail in just within the first 5 years. And the valley of death, which kind of describes the startup's life cycle when they have their minimum viable product that is already launched, but they don't have the sales or the revenue to cover these operating costs. So this kind of creates some, negative inflow of cash. And when you have the initial capital that is already exhausted, if we say that a startup already got some funding and they're not bootstrapping, this really results on the company not even surviving just because of this negative cash flow. So it's not really easy to get out of this valley of death. I've seen this already in my past experience because what I really work on is I talk with creators, I understand their project idea. They already have a prototype / MVP, whether like you're building a hardware or a software product, they have that ready and they want to go and launch it on Kickstarter. But then when they actually do launch it on Kickstarter and we raise between $100K to $400K dollars in terms of funding, which is great because they are actually charging higher than their cost of production. They have a retainer and they will say, okay, we have exited the Kickstarter phase, we have raised funding, we have built a community. So now we want to actually enter to the real market, have an e-commerce brand. But what really happens is that things get a little bit harsh, is that when you enter to the market, you need to understand that even if you have investments, let's say from crowdfunding or from even VCs, and you want to enter to the market, you need to make sure that the money that you have will sustain the amount of time, the amount of months that you will not be generating revenue. And really this plays a lot with like the investment strategy, with the way that you're really handling the money that you have. Because most of the times when an early stage startup will not really generate enough revenue to cover the cost within the first months, to realistically say. So if you suppose that like you are a founder of a startup company, calling it like XYZ, which is like a SaaS, and you obtain $5 million from crowdfunding or from any fundraising sources, you really expect to survive, let's say, in the next 3 years within this amount of money, knowing that you might not be able to generate revenue. And per se, you could be able to generate revenue, but startups, Lianna, they really think that growth is easy, and it's not. And gaining customer traction is probably the most difficult thing, especially when it comes to, finding market demand for that.
Wow, there's quite a lot to unpack there, right? And so how can startups identify and avoid these pitfalls?
That's a really good question. So we talked here about the death of Bali, and we're gonna just rewind and talk about, how can startups avoid these common pitfalls? So you definitely need to make sure that your team has the right diverse skill set. By means, if we were going to talk about a Web3 startup, and your co-founders, you're a business guy, and your co-founders are also salespeople, well, that is going to give you a rigorous process, because if you want to rely on external resources like outsourcing your development instead of having a CTO, you're going to encounter more challenges when the company wants to scale up. So I would say that most important thing is like you need to have a team with like diverse skills. Having a combination per se between like a founder that has like product background and a founder that does UX, or if a founder that has some tech background with a founder that does sales, these are very, very complementary skills to encounter. So you really need to have this set of skills that will get you to kind of avoid these pitfalls. And another thing that is also very important is that many brands don't really pivot themselves. So in a way that, for example, if you have a project idea that failed to take off, let's say on Kickstarter, when you wanted to really test the waters in the pre-market conditions, and the product didn't prove itself per se, then founders need to choose between giving up on this idea, changing the messaging, the storytelling part, or trying to pivot it in a different idea. So sometimes even a small direction can really change and help a startup crawl out of the valley of death. We already have seen this with Uber. If you remember, like Uber faced a very rocky MVP launch with like the app is not working and they had some regulatory conflicts, but they actually listened to user feedback. They pivoted it in a way that they understood that they needed to iterate some features. They needed to make it more less buggy and with like more of a better user experience. So this really underscored the value of, launching fast is not the best idea. You need to launch slow. You need to make sure your MVP is working. And most importantly, if you have a SaaS platform or Web3 project, get testers to try it out. Have a wait list and give them incentives to actually try out your product. This would really help you even get more confidence when you really launch it to the real market.
Wow, thanks for that. That's really insightful. And what are the main differences between investment opportunities in Web2 startups compared to Web3 startups?
So when it comes with Web3 venture, you can think about the, Web3 startups, they don't just need VC money. They actually need more support, more insights on sales, marketing, tokenomics, blockchain development, smart contracts, crypto regulations as well, security and more, because everything is built on chain and it really is quite different in terms of the support they need to get in order to also survive the valley of death. Because Lianna, the value of death is even different between a Web2 and a Web3 company. With Web3, it's even more rocky. We have already seen this with FTX. They lost a lot of cash flows just because of some mistakes I have done. And it's really easy for Web3 startups to really slip into the valley of death. And for example, we have seen that A16Z actually formed a crypto research support program for the startups that they invest in to kind of give a deeper insights for the companies they invest in. And Web3 is really fundamentally community driven. So with VCs, they think that it's kind of the same way that in traditional markets that they get like around 20% in terms of the state stake. But in reality, VCs see Web3 startups different. They think, well, we really believe in this idea. We don't care if we will take maximum 5% investment stake for that. They really care that this is going to really escalate and it's going to provide an exceptional growth. So they're really like, if you compare it to Web2 startups when it comes to investment from the VC side, it's much, let's say economically better is that they get a higher stake, but really Web3 startups have a growth exponential rate that is much higher than a Web2. And so this means kind of like two things. So these smaller ownership stakes might kind of like offset the capital efficiency of Web3 projects, but it also kind of outsizes the returns. So in the likelihood that the returns could be higher in a Web3 startup rather than a Web2 company. And the last thing I'd like to mention is that with VCs, they're not as in charge and in control regarding the strategy, the direction of the company, as much as they are in Web2. With Web2, it's really more about that you have a board of directors. They are the ones that, they vote on different opinions regarding the decision making of businesses. But when it comes to Web3, you have something which is a DAO. So really, like, the community is also taking part about the direction. So the more decentralized the project is, the more like autonomous the organization is going to be like. So these are things that VCs are aware of. And that's why when it comes to VCs, I'll keep this short, but you always need to look at the VCs before you look about how startups see VCs, because really VCs are the big guys that have actually the money to actually help you fund your idea. And VCs, they want to make sure that your project is good, that we don't really need to change the details or iterate it, that they believe that it's really good because they don't really have a big say about the direction or the strategy.
Yeah, and I feel like, with Web3 startups, most of the founders are pretty young, right? And they haven't had too much experience as well in running companies. So that's really useful to know in terms of, the investment opportunities, right? And what is a Pegasus company?
So you mentioned a very good point just before answering your question, is that most entrepreneurs in Web3, they're very young, mostly because they're just really into the tech. They have tried the metaverse, they're on Roblox, there are a lot of like Gen Z founders that are emerging as well. And the issue is that most, let's say, Gen Z founders, they think, okay, if I want to build a company, let me go and find a VC. But to be honest, that's not always the case. Ideally, Pegasus company is a startup that grows very significantly and makes a big impact without really needing external funding. So there are some startups that bootstrap effectively. They maintain high ownership stakes for founders and also early employees that join their team, and only raise funds later at a much higher valuation when they really want to scale globally. And for those that don't know the term bootstrapping is when you start and grow your company using your own savings and revenue you generate from the business that you built, instead of like seeking external investments from angel investors or VCs. It's kind of really a test. I'd call it a stress test base, where you're really being resourceful and efficient with the limited funds you have, and you're thinking ways on making your company survive with the revenue that you're creating. And that this has become a very crucial point, is that the more you hold on and you skip a couple of funding rounds, the more likely you're going to get a higher valuation, a higher market valuation. And not only that, but you're going to maintain this ownership stake for your company, because, what is the point of, giving a piece of your company every time you raise funds? And I'm a strong believer that you don't need to do a pre-seed round if you're not a hardware company. Well, with hardware products, you definitely need a lot of funding. And sometimes not every founder has this amount of cash to fund and also pay for the manufacturing cost. But if you are a software SaaS company, it is quite easy, if you're a tech founder, to actually just skip the pre-seed round, build your minimum viable product, you put it into the market, you find testers, you get customer feedback, And then afterwards, after you spend around 1 to 2 years and even more, kind of building traction, getting more users to use your software. Then after that, if you are thinking, does it make sense for me to ask for funding, ask for investments, and your team has the right expertise and the right background for that, then yes, that's a perfect time. But if you're a software, you're really, limiting yourself in there. And sometimes most investors, especially if you haven't really built your product yet, they will actually intervene with the strategy and the direction and also the product itself. So you might really have launched a different idea from what you have previously wanted to launch because of investors' influence on you. So I would say that there's advantages and disadvantages to that. That of course, like you retain more ownership and control of your company, and you kind of really train yourself as a founder to be efficient and focus on the available ways that you can be profitable early on. But, still, if you want to see how many startups have raised VC money, I know the media is playing like a lot. You always see like people raising Series A, Series B, pre-seed, $5 million, $10 million. But to be fair, it's a very small fraction amount of startups. So I would say that do not let media fool you, that in reality, very small amount of startups, especially pre-seed, they raise a big amount of money. Because if you want to be even like suitable to have a pre-seed, you need to have a good background. Let's say, for those that don't know what pre-seed is, it means that you raise funding before you actually have built the prototype of this product or software that you want to build. And so fundamentally speaking, when you want to go and ask for money, VCs are not going to give it to you if you don't have some startup backgrounds. And this is a bit of issue that Gen Z founders are facing, that yes, they don't have enough experience. They haven't really worked in these big tech companies. So they don't have the credibility to actually show that, yes, we are ready to build a startup with the money that you give us. And actually, that's the trend that I've been seeing lately, that a lot of young founders, they try to bootstrap until they have their MVP ready. And that's where they gain the trust of the investors.
So it sounds like proof of concept is pretty important, right? In terms of getting funding or investment. And, could you maybe expand a little bit more on the type of businesses VCs actually take in?
Of course. So with VC money, it equals impatient growth. So VCs are mostly to look at businesses with high growth potential, scalability, and also innovative solutions that are also trending in the industry. They want to see that your business is capable of growing rapidly and it's going to become a major player in the market. So software and marketplace models are a great example because they can scale quickly without a huge increase in costs. Whereas when it comes to hardware products, they're less keen on investing in something, well, unless like you're building the next Apple, then of course will see this as a high exponential growth. But it's more difficult when you're building a hardware because you will encounter a lot of production costs involved in that. And VCs right now are really keen on taking a lot of like gaming companies. Like A16Z announced this year that they're going to allocate $30 million just for gaming and AI. So now VCs they're not just like looking for high growth potential, but also what are people going to use in the next years? And it is mainly AI. AI is like booming very fast. We have Sora, we have ChatGPT 4. We're seeing that the market is, not just prematurely growing, but, people are starting to use that. And the third thing I would say that a VC is most likely to invest when you have like a strong team. Team is so important. And we've seen this like with the Y Combinator, that part of their decision making is actually to see what is the background of the team. So if you have a great product, and it's going to scale very quickly, but you don't have like the team that, as I mentioned before, has like diverse skills, they're less likely to invest in that. SaaS is big. I would say SaaS is, really booming. And it's probably one of the best businesses that a VC can invest in. And for hardware products, this is why most tech gadgets and IoT devices, they're really not taking the VC route, and instead they're launching on Kickstarter, Indiegogo, all of these crowdfunding-based companies in this sense, because it's much easier, and VCs are more into the software product.
Yeah, because I think also, sometimes for startups to approach VCs, they don't even know which VCs to approach and also how to approach them, right? So when do you think a startup should think about crowdfunding instead of seeking investor rounds?
So crowdfunding is a good option when you're looking for early stage validation and also want to build a community of supporters. It really works well for products that appeal directly to consumers. So it's more like D2C products who are really excited to pre-order or support your development. It's also a really good route if you don't have the traction or connections to attract traditional VCs funding yet. And kind of like crowdfunding serve as a great marketing tool. You can generate buzz. You can also get media attention from your product. And that's what we have done in the past. We have launched like a couple of very successful projects like Scribit, which is a robot that draws on the wall. And it got attention from BBC News, where also our founders got interviewed by the journalist, and we invited to CES, which is one of the biggest conferences in America. So you see, like, when it comes to, like, if you have a really good product and it's hardware and it's going to appear to B2C, then crowdfunding is the best route to take. You don't have to go and find some traditional VC funding and try to convince them why your product is great. This is not like Shark Tank. I think that everyone that watches Shark Tank really has this idea that, I have just this simple idea that's very practical. Let me just go to VCs and they're going to believe in it. Shark Tank is an entertainment TV show. So, if you see what kind of products are they showcasing, you wouldn't really normally get VC money from these type of products. So that's why I'm always saying that crowdfunding is a good option, and you don't have to, let's say, think that your idea is silly, because in crowdfunding, it's just what really matters is that there's like a fraction of the whole world that believes in your idea. So if even like 3% of the entire world believe in your idea, you can actually get it to crowdfund. And why am I saying this? Because there's a huge amount of traffic on Kickstarter, Indiegogo, Republic. So maybe like 97% of people will not like your idea. Maybe they think it's silly, but there will be 3% to 5% that will really like it. They will back it and they will support you. So if you have like a really good storytelling idea and you strongly believe in it, then definitely crowdfunding is the route to go. And that's why I really love my job, because I feel like creators, they can just think outside of the box, and there's no like right product. There's like a lot of like fidget tools that can help you de-stress. And these products are actually raising more than 100K on Kickstarter. So really, like, crowdfunding is the way to go. But if you're like a startup SaaS, or even like you're a startup that could be hardware and you have generated some traction, then, you could seek an investor money like VC or angel, and you can scale it further. So it really depends also on your goal. Do you really want to go global, or you just want to raise some amount of money to help you keep this as a retainer for something else? So these are let's say the two key points, is that what kind of product you're raising. And the second thing is, what is the goal that you have with using this money?
So do you think it's possible for a startup to first have crowdfunding, and then as they kind of run out of their capital to then seek investors?
I think that's a very difficult question because, normally what happens is that after they do the post crowdfunding phase, they raise money. Still, it's difficult for investors to kind of give them that money unless they show traction. Because if they see that, well, okay, you have raised around $500K on Kickstarter, you have shipped all your products to the backers as you've promised to. Okay, that's good. But what did you do with the rest of the retainer? Did you just burn it out? Because really, VCs are trying to test you and see what did you do with the retainer that you have. And most likely, in the likelihood, it never happens that you crowdfund and then you go VC. Unless if you crowdfund and then you kind of create a small amount of traction, even if it's small, and you showcase that you've actually generated revenue without crowdfunding and you went to the e-commerce and then you ask for VC money, they're most likely to give it to you. But kind of having this direct flow from crowdfunding to VC is probably difficult.
Yeah, so I guess it comes back to proof of concept again, right? And to show that, you are running the business and running the startup responsibly, Before we wrap things up, what future trends do you see emerging in the startup ecosystem over the next 5 to 10 years?
This is a golden question because I think that AGI is going to really dominate the market, and not predominantly talking here about just purely AI platforms, but startups will most likely to integrate some AI solutions in their companies. And by that, if you take, for instance, gaming, now what gaming startups are doing, they're hiring like some machine learning developers to kind of build an NPC, a non-playable character in their game that is also generated by AI and that you can train it to actually help you achieve and complete some quest in the game. So this is what now startups are preparing in the gaming sphere. And we're going to see this happening so and forth in the next years, that AI will become fundamentally a part of a startup, and it will be the engine that will actually fuel the growth of a company.
Wow, thank you so much for that. And, thank you so much, Malak, for being part of today's conversation and sharing your expertise with us.
Thank you so much, Lianna. And I'm very appreciating the podcast that you have guys created. And thank you again for always supporting women in tech.
Brilliant. And to all our fantastic listeners, I hope you've enjoyed this conversation. Don't forget to express your support by liking, subscribing, and sharing this episode. Thank you for tuning in. And until we meet again, stay well.